Good morning, everybody. This is Chris Robinson, Robinson Ag Marketing. Today is Tuesday, the 10th day of March, and we do have a USDA today. If we didn't have enough fun all in the last 3 days, now we've got a USDA, right? The good news is this rally, crude oil is still at close to $90. Right now it's trading 88. Um, it gave us a tremendous rally in the grains. No two ways about it. You got 1150 new crop beans. We traded as high as 1170. Got to remember, back in January, we were down at 1050. New crop corn traded as high as 498. It's 480 this morning, right? So yeah, maybe you didn't sell the top or anything like that, but it's still tremendous thing sitting here at 480. Again, we were down at 440, 445 in January, and we were all worried about possibly taking out the summertime low at 440. So is 55 cents, you know, worth something to you? Even at 480, is that 40 cents worth um, something to you? I think it should be, considering the marketing opportunities we've had in corn for the last, certainly for the last 2 years, right? So get after it. Um, if you've got corn in the bin, I don't know why you wouldn't use this rally to reward it and get rid of it. You could always reown it, right? If we are going to have a summertime rally, re-own it after the sale. But I call me crazy, but I like selling into big rallies, right? Especially if I'm always long. If I'm a producer, I'm always long. And again, making a sale, setting a hedge. Don't come at me saying, "Oh, you're calling a top." I am not. Okay, I'm not Babe Ruth. I don't call my shots like that. I hope that we go to the moon, but I don't want to be in a situation a year from now going, "Oh, look at this great opportunity," and if only we had done this, or if we could have done this. That's why we hedge. Um, I'm not here to argue. I'm here to try and help you make better cash sales. That's really what it comes down to. So, with this report, you can get some cheap downside protection. You can get specific protection. You can get protection for corn in the bin. You get protection for corn in the seed. I mean, it's still in the seed bag. We've got 480 corn, right? I just talked to a client. You can go out and get a 470 or a 475 for 3 reports, 45 days, for between 8 and 12 cents. Okay, and you're defending what, 50 cents, 40 cents worth of downside risk. And the same thing in the new crop beans. We're trading at 11.50. You can get yourself an 11.30, 11.20, $11. That may look pretty darn good if something goes sideways and we're back down at 10.50 beans. So that is why we hedge. Ditto for wheat. Overnight prices, real quick. May corn down a penny and a half with a pretty good sized trading range, almost a dime trading range. Dees corn down a penny and 3/4 at 480 with a kind of a tighter trading range there, just 7 cents. And the beans, we had almost a 20-cent range overnight, 11.33 to 11.51 in new crop. May beans from 11.78 to $12. We actually finished the night on highs, up on the highs in May beans. So what's going on there? I don't know. It could be something to take advantage of if you need to move some soybeans. All right, moving on to the cattle. Cattle has been basically a surrogate trade for the stock market. Stock market's calmed down here with the crude oil market coming back off those highs. The stock market's only down 100 points in the Dow. It's only down about 12 points in the S&P. That may calm things down here in the cattle and give us a chance for a recovery. The corrections that we've had in cattle have been very technical. There are gaps on the charts in cattle, 224 to 230, 10 in the April fats. There's a there's a target for the chart traders out there. There's a gap in April feeders. If you take a look at that chart, and again, if you're not familiar with what I do, a lot of the stuff I do is chart based. Um, April feeder cattle, the high is 347.62 from yesterday. The low from the previous day is 350.37. So there's a gap there on the charts. Are we going to go fill it? I don't know. I hope so. Um, what can I tell you? Set a hedge. This is probably the best marketing time to be using options versus futures, because you can get so run over with futures if you're wrong. An option market lets you, an option contract lets you have a specific hedge for a specific time uh, with a specific cost. And if you buy the option, if you just are long the option, you don't get run over with margin calls after the position is set. So that's why it's such a good choice for most farmers and producers. For traders, yeah, I get it. You probably want to be trading futures or you want to be trading a combination of it. But for 90% of farmers out there who are really, that's people that I work with, try and use these options because you've already made your big speculative bet. You're already long everything. So what you want to do is use options to capture revenue when we have these good moves while also keeping the upside open. All right, guys, this is Chris Robinson, Robinson Ag Marketing. If you're not getting my letter, go to my website, sign up, take a look at it. If you need to talk to somebody, 312 638 8868. There's still time to get some stuff on before those report. Take care.